All right, guys, how's everyone doing? Good morning. Give me a little shout out. Let me know where you guys are. I know we've got an international turnout today, a big turnout. I haven't done one of these in about a month, but we've got the weekly swings. I'm sure all you guys are getting that. Let's see who's in here. We've got Andrew, what's going on from Austin? We've got Cam from Oregon. Ryan from Springfield, Freddie from Miami, Lyle from Ohio. We've got people from all over the place. Indo, what's going on? We've got Anthony from New York, Chani from San Francisco, Leon from Boise, Gerard in my neck of the woods here in San Diego. We've got Kevin, Salt Lake City. Mark, what's going on? Arjun is from Holland. There we go. We got our first international. And here we go. Peter from London. My wife was born in London. Jag from Atlanta. We've got William from San Antonio. Kevin from Cincinnati. You guys are from all over the place. Armin, what's going on? All right, guys. We'll dig in a few minutes here. Wait a couple of minutes just to make sure everyone gets in. At least on the West Coast here, it's real early. What's up, Matt from Gainesville? Jamel from Los Angeles. I was actually supposed to be in Los Angeles this weekend. Let's see who else is. We've got Mike from Knoxville. There's so many of you guys. I can't shout out everyone. Anthony from Delaware. Tay from Singapore. It must be. I would imagine it's evening in Singapore. All right, we've got Martin from Macedonia. Neil from Scotland. What's going on, everybody? I usually start these with a book recommendation. I read a lot, about a book a week. I've been rereading some of my favorites. Fooled by Randomness. Really good book. I don't tend to read trading books, but books that in some way or another will help me with trading. And this is one of them that was very influential. Fooled by Randomness. It's by someone who was a hedge fund manager. What's his name? Nassim Nicholas Taleb. And one of the big points of this book that will help you with trading, he talks a lot about the role of luck, randomness. And as traders, we often have to figure out what's luck, where do we have our edge? Where is our probability? So really good book. Definitely check that one out. So today, Stocks and Coffee, we're going to do what we normally do, which is analyze the market, get into some of the hot industries, talk about some stocks. We're in earnings season, so we're going to talk about some of the earnings breakouts and breakdowns that have already happened that we're looking for setups to trade. And then at the end, I'm going to talk about our new class. I do 4 or 5 of these classes a year, and I've gotten heavy into retirement planning. So we're doing a class on that. We're going to delve deep into some of the topics that I've listed here. And I'm going to talk a little about non-correlation, which will help you not only in retirement planning, but we actually talk a lot about this in our swing trading portfolios as well. So I'll get a little into that. Next weekend, I'm going to do a webinar specifically on retirement planning. That's free. It's not part of the class. You guys can attend that. And then the class will be starting during the week. So I think that'll be around the 16th or 17th, if I have my dates right. But let's get to what we normally do. Let's analyze the market. And I still have Robinhood up. How many of you guys have actually traded Robinhood? How many of you guys have just been sitting back watching it? Okay, someone was real quick here. Someone saying, Wayne was saying no audio, but it looks like everyone else is fine with audio. Okay, good. And you should be seeing my screen here. I pointed this out to Bulls on Wall Street members yesterday, I think it was yesterday or Thursday, that while this is a speculative play, it's very risky. Leon just mentioned he's on the sideline, and that's a good thing. Unless you're day trading where you don't have to worry about gap ups and gap downs. But for swing, a little bit risky for us now, but there is an extremely low risk, high reward setup. Take the extreme out. There's a low risk, high reward setup. I don't want to make it sound too good because I do think it's speculative in case there was some kind of big gap down, which actually that book Fooled in Randomness talks about black swan events and how you have to plan for these kind of outlier things. But with Hood here, there could definitely be a big gap down or gap up any day of the week, right? And we saw a big gap up here 3 trading days ago. That would be Wednesday. But it has definitely formed a range that makes it very easy for us to know where to get out of the trade. So if you were doing this normal position size was a third, you might want to do like 400 shares, maybe do 40 or 50 to limit that, to help you limit that risk a little bit. But think about what you could do here. If you enter here around where it is now at 55, we have a clearly defined range. So say we went a little under the range here, which we'd want to do. When you place your stop here, do not place it right at the low. There's a good chance you're going to get stop gunned. And I think this candle here, I think was a lot of stop gunning, because on this day, a lot of at 55, you place your stop down here, let's say at 49. So you're risking 6 points. So say you had 100 shares, you're risking $600, assuming that would fit your account size. So you generally don't want to be risking more than 1 or 2% of your account. So let's say $600 would work for you. So that's how much you'd be risking with 100 shares. We're targeting the range here at 85. So we have well-defined resistance level. We have a well-defined stop level. So target 85. So for 6 points of risk, we are getting 30 points. And you don't even have to go all the way to the top. You could go, even here is 15 points. So that's 3 to 1. But if you were going for the top of the range, 6 to 30, that's about 5 to 1 risk reward. So now that's not factoring probability. What's the probability of that being successful? Is it even 50%? Maybe not. But even if it was 30 or 40%, meaning if you take a trade like this 10 times and you only win 3 or 4 times, you're still going to be crushing it, because you're getting 5 to 1 on your risk. So that's the way you want to be thinking about this: probabilities, and then what is my risk, and how do those things go together? So low risk, high reward in terms of the risk reward. Probability, maybe you get stopped out quite on this, but when you win, you're going to win really big. So it's worth that small 6-point risk to potentially get that 30 points. And that's the way we normally want to be thinking about our trades in terms of risk reward. All right, enough about that. Let's get to the market. And it looks like you guys might have some questions here. Let's see. So it looks like a few of you guys did trade it. Kurzden has a stop at 40. More trade, you'll get stopped out less by doing that. Okay, Armin can't trade from Europe. Armin's a little worried about choppiness in Europe. Okay. Anthony is asking, would you put a hard stop? I tell everyone to see, so you don't get stop gunned. But in my mind, I would have a pretty hard stop wherever I've decided to put it. All right. Okay. And Freddie, you can. Freddie had a question specifically about TC2000. You can email me and I'll get back to you on that, so we don't waste everyone's time here. But here are my contacts. Take a screenshot here if you want to get a hold of me anytime. You guys are Bulls on Wall Street family members. If you're attending our stuff here, I definitely will get back to you. So singjd1@aol.com. And of course, Bulls on Wall Street, Paul J. Singh, my own website. Twitter, definitely follow me on Twitter and Instagram. I'm posting stories and videos all the time. All right, so let's get to the topic at hand. That is the market analysis. So first of all, let's look at SPY. We go surface level and then we dig a little deeper. So let's do the surface level stuff first. Very easy to see we are in an uptrend. In the last couple of months here, since summer has started, we'll say since May, there has been some volatility and some deep pullbacks, and it seems like we're getting more and more of these deep pullbacks. That often happens when a trend is getting a little mature. So that's something to think about that maybe is a little concerning, that we're getting more and more, like you can see here, from November to February, March, actually till March, say, we didn't have any really big deep pullbacks. Maybe this kind of this one that touched the 50-day moving average back in January here. But there was a pretty strong period here where it was just uptrend, 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 and your natural kind of consolidations and pullbacks. Now, you know, it seems like every month we're getting 1 to 2 deep pullbacks. They have been buying opportunities, and that's pretty much been the trend since the pandemic low, that every dip is a buying opportunity, no matter how scary they've been. So, but we are getting more pullbacks. Usually that means the trend is getting mature, and at some point maybe we get a deeper pullback. So we'll wait and see about that. But we are at all-time highs again. Qs pretty much the same thing, and the pullbacks have been even deeper on the Qs, but now we're in a really strong trend. Qs showing relative strength to SPY, and IWM, this is what's a little bit concerning. We essentially have uptrend in SPY, we have uptrend in technology in the Qs, and small caps pretty much range bound still. So, you know, if we think about the line on SPY, it's like this. The line on Qs is not only like this, but then it starts to really explode here, whereas IWM is just straight across, range bound. So we would like to see that improve. The market's always best when small caps are doing good as well. And we do know, we're going to talk about the industries in a second here, but the reopens, which had been very strong, that's stocks that are sensitive to what's happened since that March low, the pandemic. That would be airlines, restaurants, casinos, hotels, hospitality, anything related to travel. All this stuff has been getting, while it was very strong just a few months ago, when it seemed like the vaccines were working and Corona was all kind of dying down. But since the Delta variant and all the scary news, whatever we think of how much of it is sensationalized or whatever, some of these areas have been getting hit again. So if we look at airlines, we can see, whereas a lot of technology is going like this, airlines are going like this after being in a strong trend. And that's part of why IWM is range bound right now. So we definitely want to see improvement in that. Okay, so that's the surface level. Now let's get to market breadth and talk a little about seasonality as well. So I didn't post the chart up here, but just know historically August and September, especially August, tend to be choppy months. Historically, going back 30 or 40 years, August is break even. Of course, every year is different. Last year, August was strong. So, but probabilities say it's going to be a choppy month. So we have to really, really find the stocks that hopefully won't be so choppy. But know that seasonality, not great in August, September. What tends to happen, July tends to be a strong month. Earnings season is starting, the new earnings season. August and September tend to be choppy. October sometimes really strong. Sometimes we have some of our worst months in October. And then there's a year-end push. And November, December tend to be very strong. So if you're thinking about where you want to lay back low a little bit, where you want to get really aggressive, towards the end of the year, once fall hits is when you really want to, end of fall is when you really start wanting to get aggressive. But it doesn't mean you can't, find good things to trade during this period. And again, every year is different. Yet last year, August was strong. So that's a little about on seasonality. Let's look at market breadth. One of my favorite things to do, one is compare IWM to SPY, and we know that's weak. So maybe not the best market breadth there. And then SPY and the Qs, you guys who follow me know this very well. SPY is not equally weighted. Some of the bigger guys are worth a lot more. So if we took the 500 S&P 500 stocks, they should all be worth 0.2 to make 100%. Apple alone is worth 3%. The top 10 holdings are worth close to 30% of SPY. So you can see how much they dominate what SPY is doing. So while it's helpful to look at SPY, I also like to look at RSP, which is an equal weighted ETF. You can see here, Invesco S&P 500 equal weight. So what this does is equal weight all of them. So Apple is not worth any more than CTVA or DXC or BLL. They're all worth 0.2 within SPY. So I like to do a comparison. If SPY is hitting all-time highs, what is RSP doing? And notice here, RSP is hitting all-time highs, which is good. We want to see that. A little while ago, it wasn't, while SPY was, and then we had the big market dip. But also compare here the gap between the 50-day moving average and SPY. Notice here, there's a bigger gap than on RSP. So it's a tighter range here, meaning it's not, if we were to figure that out in terms of percentages, SPY would be up a higher percentage than RSP. So RSP is lagging a little bit, but it's not hugely concerning. It still looks strong. And then with the Qs, which is only 100 stocks, we can look at QQEW. And here, it's actually stronger than the Qs, if you look at the comparison here. So look at the Qs here, still very strong, but QQEW, so no concerns here. Market breadth is good within technology. So the biggest concern in the market, I would say right now, is some of the smaller stuff, the small caps, and stuff that is sensitive to the pandemic type stuff. So we should be aware of that. And that helps us know, one, where to go in terms of our trading, and also how aggressive and maybe cautious we should be. So I would say there's nothing right now saying we have to be super cautious. There are some periods where we'll say, you know what, we shouldn't even be trading right now. We're not at that point, but we do have to pick our spots here. Okay, so that's how market analysis will help us. Now let's look at the top industries last week. You can go into, if you have TC2000, you can go into the industry indexes here and then sort them. I'm just going to pull up the ETFs that I track, and we can do the 5-day here. So the best performers last week. And let's go to biotech here. So biotech, very strong. That makes sense, right? There's all this talk about Delta. So now biotech is in the news. So it's important in that regard. Also, there was a few months ago, the big Alzheimer's news, and that had an impact on biotech as well. A lot of companies working on that stuff. So biotech has been strong, showing relative strength. You can see here above the pandemic, pre-pandemic. Let's get over here. Look at where the pre-pandemic highs were and look at where we are now right now. So biotech has been showing relative strength, and it's testing its all-time high. IBB is a biotech ETF. So we definitely should be paying attention. What does that tell us? One, you could trade the ETF, which would actually be very helpful in that retirement planning trading we're going to talk about later. But definitely we should be paying attention to biotech. You can trade the ETF, or you can find biotech. You should be looking at biotech stocks to trade. And on TC2000, very easy. You can pull up IBB, and here you have all the stocks that make up IBB, and then you can analyze the charts. We're not going to do that here. But no, biotech is an area you should be watching very closely. Another one, financials, very strong here. Now, we talked about this when earnings season started a few weeks ago. The financials stocks, the banks, Goldman Sachs, Morgan Stanley, Bank of America, JP Morgan, and then the smaller regional banks, their reactions to earnings overall were not great. And I think a lot of that was fear with what was going on with one. We're not talking about it as much now, but there was a lot of worries about inflation. What is the Fed going to do? That's kind of gone out the window right now. It's still there, lingering, but I think the market feels pretty safe that the Fed is going to help out with that, meaning they're not going to raise rates, and that's what the worry was. So financials took a little bit of a hit. And during earnings season, the reactions weren't great for some of the big banks. But what was interesting was, if you looked at the actual earnings, they were very good. A lot of them had blowout earnings. So we were watching that very closely. We expected a turnaround in the ETF, and we're seeing that now. And on Friday, we got the breakout. So definitely financials should be in play. You can do the bigger banks like Goldman Sachs, Bank of America, which let's just pull up Bank of America because it's a good example of how it was very poor during earnings. I think this was the gap down right here, down to 36. And you can see since it has been very strong, and now it's about to remount the 50-day moving average. And then Goldman Sachs was a little weak around earnings season. You can see here now back to highs. So, and then there's smaller banks too. You could do like SIVB, and you can see how strong that is as well. So definitely be paying attention to financials, and you can use the leveraged ETF, which is FAS. And you can see a nice pattern here breaking out over the 50-day moving average, was up 5% on Friday, or go through the stocks that make up these ETFs. Okay, so that's financials. Cloud, no surprise here. Cloud is back in the news with all of the fears of going back to work. Again, it feels like Groundhog Day. We're back to 2020 again. Cloud, which a lot of these cloud-based or at-home stuff was actually looking like topping patterns, now are back in play. And if we look at those ETFs here, look at how many are strong, are at the top of the list here. CLOU, that's a cloud ETF. ARC, which is very big, has a lot of cloud stuff in it. WCLD, another cloud. Let's pull these up here. Here's cloud or cloud. Here's ARC. Here's WCLD. IGV, which is software, which is going to have a lot of cloud-based stuff in it. Sky, also cloud computing. You can see how strong that is. And then here's a work from home ETF. This one is at all-time highs. So look at how weak they were back here when everyone thought that, Corona was out of the way, vaccine, everyone's getting their vaccines, and these things, people thought, everyone's going to be going back to work. And you can see it looked like a topping pattern, but now is back at high. So we definitely should be paying attention to these guys. Look at Zoom here, which we're using right now. You can see here, it looked like a topping pattern, but now again is remounting the key moving averages and looks like it might be back on trend. So definitely should be paying attention to cloud. Semiconductors, also very strong. Here, look at the ETF at all-time highs, fantastic trend. And then, one of NVIDIA here at all-time highs, AMD at all-time highs. So definitely should be paying attention to semiconductors as well. Finally, let's look at airlines. Airlines have been beaten down. The ETF is aptly named Jets. And it was one of the leaders last week, even though it was so beaten down. You can see how beaten down it was. It was sitting around 21 and it's now up to 23. Looks like we might have a higher low in play. In bulls, we actually took, and I actually am in AAL. Let me find current. Here we go. Here's AAL, very similar pattern. The reason I chose AAL is it's showing a little relative strength to the other airlines. It's above its 200-day moving average, while a lot of the other airlines like UAL here, Southwest, they're below their 200-day moving average. So AAL within that space showing a little bit of relative strength. So airlines could be back in play. I'd feel much more comfortable here if Jets were able to remount these moving averages, but might be a good value play here with airlines. So definitely be watching that as well. So obviously there's other areas to be watching, but you'll get a lot of good candidates for trades within these 5 areas: financials, biotech, cloud, semis, and airlines. All right, now let's look at, I'm just going to quickly go through a list of some breakouts and breakdowns from this third quarter. Steve, I compiled that ETF list. Okay, Cam is asking about HA, which is Hawaiian Airlines, and is asking why. So Cam's question is, why is Hawaiian Airlines not stronger when it's at max capacity right now? And some of these airlines are actually back to pre-pandemic levels or even more than that. It's fear. That's the reason. With all the Delta stuff, it's obviously a lot of it is manufactured, but some of it might be real. And the market always gets scared at this kind of stuff, which can often be good opportunities. But yeah, it was interesting that most of the airlines had good things to say. Their revenues were where they should be, either close to pre-pandemic levels, or some were beating pre-pandemic levels, but the stocks haven't followed through. Okay, Armin talking about Zoom. I think we covered that. Armin also mentioned BIIB. That was the big Alzheimer's stock that had all the Alzheimer's stocks popping a couple of months ago. Okay, let's look at the breakouts now. So, during earnings season, we're tracking 5% breakouts and breakdowns. After the breakout or breakdown, we start looking for patterns to trade. We won't go into the patterns here, but no, I trade 7 or 8 different patterns off of earnings, breakouts and breakdowns. So let's just quickly look at some of these. I've got the list up here if you want to take a screenshot of these things. Here's D-Dog, classic breakout, over the range, heavy volume. That's basically what we're looking at. Big breakout, heavy volume, over a range. Then I'll look at things like, does it have short interest? Does it historically run after breakouts? And some other stuff as well. What's a float size? What's the volume compared to the float size? But huge breakout here. Now looks like it's starting to consolidate. PCTY broke out on Friday. GoGo broke out 2 days ago. Not really, it's still within the range, so I'm not really interested in this one. MD, nice breakout here over the 50-day moving average. This is a low floater in medical devices, which have been strong. Melly, big breakout. This is a volatile stock that tends to have very strong trends. This could be the catalyst for a new trend after a big pullback. Hubs, all-time high breakout. GSI breaking the range here, looks really strong. All these breakouts are going to look very similar. I'll just flip through these. It's mostly the same stuff. AAON is interesting. It's in building materials, which was strong and has pulled back. But I would assume this is related to housing. Yeah, Aaron. Yeah, so this is related to housing. And housing has been strong. And this might be the break of this downtrend now with this breakout. So we'll see how, if this were to remount the 200-day moving average, I think this is a really good candidate. Yelp, AMD broke out of a year-long range on earnings. Crocs, footwear has been very strong. GT, Goodyear. Goodyear needs to get up over the 50-day moving average, but it still was a 6% breakout. Monster tends to be a very volatile stock and can go on very strong trends. So we'll see if this breakout does that. Snapchat, Domino's, Chipotle, Google. Google had a nice breakout, but it was very extended. And Twitter here. Twitter's been weak since the breakout, and I'm actually in that one. All right, now let's look at some breakdowns. Now, you would think, because the stock had a poor reaction to earnings, broke down, that I'd be looking to short these things. I actually look for good reversal spots. A lot of times these breakdowns on earnings are overreaction. So if it's a strong stock that has a momentary reaction to earnings, I start looking for reversals. Like you could see that in in Bank of America. Big gap down, I think it was about 5%, which is a lot for a big bank. And look what it's done since. So Bank of America, Tesla gap down on earnings. It's been strong since. PayPal, here was the earnings gap down, now starting to come back. I'm watching for it to remount the moving averages. UPS, Intel, Starbucks, Spotify, Cheesecake Factory, Sam Adams, and Roku. Roku's interesting. It's been very strong. You would think it'd also be a work from home play, and work from home has been strong, but gap down on earnings, and it had great earnings, by the way. And then here, we'll look to see if it recovers and can get back up over the 9 EMA. Gadge mentioned Pinterest. Yeah, that was strong. David mentioned DRNA. I have not looked at this stock, which is rare for me to not know a stock, but let's take a look at DRNA. Okay, big gap down here. Yeah, you could definitely be watching that. I don't know what the news was on this, but definitely I would pay attention to that gap down. Tay is asking about Skechers. Footwear has been strong, and Skechers is at all-time highs. So, yeah, I'm not sure what your question is, Tay. Cam's asking about PATK. Looks strong. I'm not really familiar with this stock. Looks like it's in building materials, low float. Has been trending nicely. Definitely, I think, a good stock to put on your focus list. All right, guys. So that's what I wanted to cover today. Now let's talk a little bit about the retirement class. And I'm going to get into non-correlation, which will help you with your swing trading as well. I'm not going to get into this right now. Next, into the actual content of it. Next week, we'll do a webinar, and I actually have a link here, not to the webinar, but this is to the actual class. If you're interested in that, there's the link. You should have it in the chat. We're going to go over, building a retirement portfolio, passive investing, 401ks, IRAs. We're going to delve really deep into it, the different kinds, mistakes a lot of people make, a lot of you might be making in terms of fees, picking the right ones, really understanding the tax implications, and how these little mistakes will impact hugely when you think about compounding over 10 or 20 years. Then we'll really dig into self-directed trading. And that's kind of what this is about. How do we, you're already going to do well in terms of compounding, but how do we beat the market? And these little edges we can get make a huge difference over time. So we'll talk about stocks and ETFs, setups and timing, modifying our swing trading strategies and moving towards position trading, longer term type trades, and then beating the market for explosive growth. And next week, we'll really dig into it. That link I sent you is to the class, and you can see what's covered in there. And all of the classes we've done, or I've done, related to swing trading have had a really good positive reviews. I know a lot of you have taken some of the classes. I'm going to quickly hit non-correlation right now. Well, actually, we're going to really dig into it related to, planning, your retirement portfolios and the ways to do that. But let's even talk about it here with swing trading, which I know a lot of you guys are doing. So when you're building your portfolio, and right now, let's just think swing portfolio. Let's say you're going to have 7 or 8 positions on. And, you're risking, most of you guys probably know a lot about risk, and you shouldn't be risking, say, more than 1% on trade. So if your account is 100,000, you can risk 1,000 per trade. That's not position size. That's how much you would lose in the trade, right? So let's say you have 7 or 8 positions, but they're all in software, or they're all in tech. What's going to happen when tech goes down or software goes down? You're not risking 1%. You're essentially risking 7 or 8%, which is going to be a huge hit on your account. So you should always be thinking about correlation and trying to get it so your positions are not correlated. This is really important in the retirement planning, but also in our swing trading. So for instance, if I've got 7 or 8 positions, obviously I'm going to be looking for good setups, but I don't want them all to be in the same area. That's going to pull back the same way. And you guys have seen in the market, especially in this market, there are periods where, say, semiconductors do really well, but energy will be doing poorly. These reopened stocks will be really strong, but that usually means that software is doing poorly. So you want this stuff non-correlated. So you might want to take something like Apple, and then maybe a software stock like CrowdStrike. And then if the setup is there, you would want maybe energy or financials. If you look at the top industries that I pointed to here, this is non-correlated. This is exactly what we're talking about here. You have financials, you have biotech, you have cloud, you have semis, and airlines. Some of these are a little correlated, semis, cloud, and biotech could be, but you can have periods where biotech is moving and semis are not, or cloud is moving and semis are not. So if you just went with this, where you took one financial, one biotech, one cloud, one semis, one airline, unless there was a huge dip in the market, you're really non-correlated here. So you don't want that spot where everything is going down at the same time. That differs from diversification. And some people will say, well, why don't I just diversify then and just put, the same amount in all these different areas? If you're doing that, you might as well just take SPY, right? That's not what we're talking about here. We still want to go to the areas where we have an edge. We just want to make sure they're not all tied together. Ways to non-correlate. And this is more related to the retirement planning, but one, taking value plays. Think of things that are beaten down, like airlines right now. The Buffett strategy where you buy low in good areas, but you don't want everything in value because value might be hit for a long time. So you might have something with value, you might have something with growth, like the tech stocks. You can non-correlate by setups. So we have some setups that are, beaten down rubber band setups or bottom formations then we have other setups that are continuation patterns. So if you're taking all continuation patterns, if those patterns start to fail, you're really going to get hit. But if you have, some bottom formation, some stuff that's extended, that's another way to non-correlate. You can correlate by market cap. We know right now small caps are not doing good. The bigger stocks are doing a little better right now. But there are periods where small caps will be doing really good. So you want to get a mix of small cap versus the bigger stuff. You could simply doing that for your retirement. You can have IWM and SPY. So those two are not correlated. We see that right now, that they are very different. But if you look at the history, even recent history, you will see there's periods where IWM is much stronger than SPY, which was just a little while ago. The end of last year, small caps were crushing SPY. So they have not been correlated. So that's again another way to think about correlation. You can do that long term, but it's also really important in your swing trading when you're building your swing trading portfolio to not have everything correlated together. All right, guys, so that's a little introduction to what we will be going over in that class. I think I sent the link out to you. Let me send it to you one more time. I don't think we have next week's webinar on this class scheduled yet, but if you're on the Bulls on Wall Street email list, you will get that. And of course, if you're following me on Twitter or Bulls on Wall Street on Twitter, you'll get that link as well. All right, guys, so thanks for joining me this morning. Have a fantastic weekend. If you guys have any questions at all about what we went over today, about stocks in general, or the class that's coming up, shoot me a message. I'll get back to you, usually same day. Maybe it'll take a day, but I will definitely get back to you guys. Hopefully you learned something this morning. Contact me. Let me know how you're doing. Did you take any trades in these areas? And I will see you. We'll do another one of these coffees. We usually do them twice a month, once or twice a month. So I'll see you with this. And then the weekly swing I do every week. So make sure you're getting that as well. All right, guys, enjoy your weekend.